Welcome to This Explainer. Today, we're diving straight into what I like to call the Notepad panic. We're going to demystify this whole US-Japan currency intervention that's been making everyone lose their minds. So, we're unraveling a viral financial mystery today. You've probably seen the headlines or the social media panic over the last few days. Well, we're cutting through all that noise. No apocalyptic predictions, just the cold, hard facts. It all started with one single crazy image. A Reuters photographer managed to get a shot literally right over the shoulder of the US Treasury Secretary. And right there, scribbled on his notepad, was this underlined phrase, buy Japanese yen 5 to 10 billion. I mean, wow, right? Within 48 hours, that one snapshot spread like wildfire. Suddenly, it was proof of a massive secret bailout of the Japanese yen. People were genuinely saying the global financial system was about to collapse. Now look, an intervention did happen. Both Tokyo and Washington confirmed that. But the scale and the wild stories being spun online, completely, absolutely wrong.
Okay, let's dive into this. The absolute biggest rumor to come out of this whole notepad frenzy is the idea that the US is somehow selling out Europe to pay for this bailout. But here's the thing. When you completely misunderstand the scale of a financial event, your reaction as an investor is almost guaranteed to be the wrong one. And your reaction is the only thing you actually control. So, we're putting on our financial detective hats today. We're going to frame this entire analysis around three very specific numbers. Numbers that literally dismantle those internet rumors and completely flip the narrative on its head.
But first, to really get those numbers, we need a quick timeline of the verified facts. So, Thursday, July 30th. The US dollar to Japanese yen exchange rate hits 163.73. That is a massive deal. It's the absolute weakest the yen has been since 1986. We are talking a 40-year low here. Right at that peak, Japan steps in aggressively to defend its currency. Then, fast forward to Friday. The Financial Times reports that the New York Fed, acting through Morgan Stanley and Goldman Sachs, sold euros to buy yen on behalf of the US Treasury. By Monday, Japan's Ministry of Finance officially confirms the joint intervention, basically saying they won't hesitate to do it again. The market obviously freaks out, and the exchange rate just plummets straight down to 157.
So now we have to ask the multi-billion-dollar question, and honestly, this is the root of the panic for a lot of European investors. If Washington wanted to help Japan buy yen, why on earth did the US use our euros instead of their own dollars? I get it. It feels super targeted, right? Why use the currency that literally pays European salaries, pensions, and mortgages?
Well, what's really fascinating here is that the answer has absolutely zero to do with some deliberate attack on European citizens. It is purely mechanical. According to Bloomberg, the US used the euro for one simple reason. They didn't want to weaken the US dollar. Think about it. Selling dollars to buy yen naturally drives the dollar's value down. And a weaker dollar directly conflicts with the official economic agenda of the Trump administration and Scott Bessent. So, selling euros just bypasses that entire problem. It wasn't a slight against Europe at all. The euro was just used as a convenient, mechanical tool to get the trade done without messing up domestic US policy.
All right, let's shift gears a bit. Let's look at how this feeds into the wider market panic, specifically this thing called the carry trade. It sounds complex, but here's the deal. For almost 30 years, Japan has kept its interest rates at basically zero. This made the yen literally the cheapest currency on the planet to borrow. So investors borrow yen for practically nothing, convert it into US dollars, and then buy high-yield stuff like US treasuries or stocks. You just sit back and pocket the difference in interest. It's a beautiful loop, until the yen suddenly gets stronger. Because if the yen shoots up in value, that free loan suddenly becomes incredibly expensive to pay back. To cover those positions, highly leveraged investors have to panic sell their most liquid assets, and that means dumping US stocks and bonds fast.
And here is where we hit our second crucial number. And man, does it debunk the whole apocalyptic narrative. Over a totally frantic 72-hour period, online rumors were screaming that this unwinding carry trade was worth anywhere from $4 to $8 trillion. An $8 trillion bomb just waiting to nuke the global market. But if we look at the official Bank for International Settlements, the BIS, the guys who literally measure these flows for a living, their data estimated the currency carry trade at around 40 trillion yen. That's roughly 250 billion US dollars. Even if we use the higher estimates from UBS, you're looking at maybe 500 billion. Now, don't get me wrong, 250 to 500 billion is a massive chunk of change, but it is galaxies away from the $8 trillion apocalypse being peddled by panic accounts online. However, the danger wasn't totally made up. The real problem was aimed directly at Washington's debt.
See, Japan is the single largest foreign holder of U.S. public debt. They hold nearly $1.2 trillion of it. When Tokyo decides to defend the yen, they need U.S. dollars to do it. And the fastest way to get those dollars? Sell off their U.S. Treasury bonds. But if Japan suddenly floods the open market by selling billions in U.S. bonds, bond yields are going to absolutely skyrocket. And that is a massive, urgent problem for America. The U.S. desperately needs to refinance a mountain of its own debt this year, and they literally cannot afford soaring interest rates.
And this brings us to the hidden, quite frankly, brilliant mechanic of this whole story. Enter the FIMA facility. The Japanese Ministry of Finance announced they were going to use this very specific Federal Reserve tool. Basically, FIMA allows a foreign central bank to get U.S. dollars simply by pledging their U.S. treasuries as collateral. They don't actually have to sell them on the open market. This completely disarmed the most dangerous part of the crisis. So no, this wasn't the global financial system in a full-blown panic. It was just two national treasuries looking at the exact same dangerous feedback loop and deciding to break it together before it caused U.S. yields to spike.
Now, to really fully appreciate why that selling out Europe rumor is just mathematically false, we need to look at the sheer scale of a currency intervention. When the Bank of Japan decided to step in and defend the yen, the data shows they spent roughly $59 billion in a single day. $59 billion. Just keep that massive number in your head for a second.
Because now we're looking at our third crucial number. And we pulled this straight from the U.S. Treasury's own weekly publication on their reserve positions. The entire United States reserve of euros, we're talking securities and deposits combined, totals just over $26 billion. Total. The Bank of Japan spent $59 billion in one day. The entire U.S. euro arsenal is only $26 billion. So the whole idea that the U.S. sold out Europe with some massive secret euro dump, it's just mathematically impossible. There were no 50 billion euros to sell because the U.S. literally does not have them.
So you might be wondering, if the U.S. didn't even have the cash to fund a massive intervention, what was the point of the whole Notepad thing? Well, think about it. Scott Bessent has managed hedge funds his entire life. His whole background is high-stakes investing. Leaving a highly visible note that says 5 to 10 billion right where a photographer could snap it? Come on, that was no accident. That was a calculated communication strategy. When the market is leaning super heavily to one side, uncertainty is way more expensive for speculators than actual billions. The message to the market wasn't, we have more money than you. The message was, we're stepping in and you have no idea when. It's a remarkably cheap, highly effective way to scare off speculators without actually spending massive amounts of capital.
So, what does this all mean? How does all this high-level macroeconomic maneuvering actually impact your wallet? What does it mean for your salary, your investments, and your loans in Europe? Because while the headlines are out there screaming about global resets, the real-world effects are much more grounded, and they require a calm, structured approach.
Let's break this down into 3 key areas for European investors. First up, if you're holding an unhedged global ETF, something like the SWDA, you need to remember it holds a mountain of US dollars. A stronger yen usually goes hand in hand with a weaker dollar, and a weaker dollar means your returns, once you convert them back into euros, might be lower, even if the actual stocks went up. Now, that's not a reason to panic sell. It just means you need to understand currency risk and maybe look into hedging strategies. Second, if you've got an automated accumulation plan, a PAC, these weeks of absolute media panic are exactly why they exist. Keep them running. They literally thrive on this kind of volatility. Finally, variable mortgages. Pay attention here. The ECB recently left rates at 2.25%. If major global buyers like Japan step back from buying bonds, the pressure on long-term yields stays high. What that means for you is, don't assume your variable mortgage rate is going to drop rapidly anytime soon.
And this brilliantly illustrates how we transition from all this macro news into actionable data on the charts. If we look at the volume, the massive point of control, which was the major support level for the USD-JPY upward trend, was broken right at 158.85. Buyers really tried to defend it, but it collapsed. So now we're watching a new resistance zone right between 159.15 and 159.5. If the price returns to that zone, sellers will likely step up to defend their positions, which could push it back down. For the euro to yen pair, we're keeping an eye on a key resistance area just below 184.00, sitting right around 183.80. Now, to be clear, this isn't financial advice to just blindly go trade, but these are the precise technical levels where market mechanics are going to battle it out next. Ultimately, we don't know for sure if the yen will keep strengthening long term. We don't know if there'll be more interventions tomorrow. But here's the thing, your financial well-being shouldn't depend on answering those impossible questions. If a 4% swing in a currency pair throws you into an absolute panic, the problem isn't Japan and it isn't the dollar. The problem is you're carrying way more risk than you thought and you're doing it without a proper safety net.
So I'll leave you with this question. Are you wasting your energy trying to predict the next apocalyptic headline based on a blurry photo of a notepad? Or are you actually managing your risk? Thanks for joining me for this analysis. Stay focused, stay structured, and I will see you in the next explainer.